let's get to the big corporate development yesterday. Godrej Consumer Products has announced that it will buy Raymond's FMCG business, Raymond Consumer Care, for 2,825 crore rupees. My colleague Shilpa caught up with Gautam Singhania, Chairman and Managing Director, and Amit Agarwal, CFO of Raymond, and began by asking Amit on the contours of this deal and about the demerger. Listen in.
Today we have signed the BTA business transfer agreement, which is a slum sale of our FMCG business, which comprises of Park Avenue, KSDOs, as well as the Kama Sutra, condom and sexual wellness business. This is the business which we have sold to GCPL for a price of 2,825 crores.
Right.
Now, we have kept the manufacturing facility of condoms at the Aurangabad plant, which will do the B2B business and will supply to GCPL and some of the other customers. So right. That's the broad contour of the deal with the GCPL. Now, as far as the demerger is concerned, the RCCL will get the cash, and we have at the Raymond Limited lifestyle business, which is having the debt. We will demerge the lifestyle business from Raymond Limited into RCCL along with the assets and liabilities as well as debt, so that the cash which is at RCCL from the sale proceeds of FMCG business can be used to repay the debt, and therefore making lifestyle business a debt-free business.
Right.
Automatically what happens, since the Raymond lifestyle business is a listed entity which is getting demerged into Raymond Consumer Care Limited, which is an unlisted business, will automatically get a listed company.
Right.
So therefore we are achieving a pure play lifestyle listed net debt free business.
Right.
So that's one. Second thing, what also happens is that the Raymond Limited will then have the core as real estate business, which we are developing in a larger manner, which will also have investments into the engineering business as well as in the denim business.
Right.
So that's the one we are talking about, the demerger.
So can you tell us what the net debt is then at this point, and basis the stake that you have currently in RCCL, right? So my estimate is about 1,400 crores comes in. So how much of that is going to get covered? How much of the net debt is that going to cover, and how much more will the promoter have to put in?
So actually, if you see, the RCCL is jointly held by the promoter entity as well as Raymond Limited. So to the tune of 49% is held by the promoter and 47% by Raymond.
Right.
So the money which comes in will be in RCCL, and the promoter is putting his contribution or his stake sale proceeds into the lifestyle business in RCCL in order to ensure that it becomes a completely net debt free.
Right.
Because obviously you will have to pay tax on the sale of this asset. So net of tax, we see there is a substantial amount which is available to take care and make the group a net debt free group. Because at the end of December, our net debt at Raymond consolidated level was 930 crores.
Okay.
So that will ensure that we become a...
But for the lifestyle business, what was the...
So lifestyle business had a gross debt of almost 2,000 crores, which is coming down.
Okay.
And therefore, it is easier for us to repay the entire debt of lifestyle business.
Right. So net, what does the promoter, Mr. Singhania, get out of this entire deal?
You know, I think there's many things. One, of course, you got great value on the business that you sold. It certainly helps me achieve the dream of unbundling and, you know, demerging the companies, which is what the market always wanted.
Right.
They wanted focused companies doing focused businesses. So we will now have the lifestyle all come under Raymond Consumer Care, and it'll be a single company. And number three, I think we'll become net debt free.
Right.
So net debt free is something the market has always asked us when you will be. We had committed that we will be net debt free by March 25. I always said subtly that we will, you know, with a little bit of luck, do it earlier. And we're doing it 2 years earlier than our commitment. So I think this all will create exponential shareholder value. Now you'll have totally two different businesses with this own, and it'll help me to actually achieve my dream of putting proper governance in place for both the companies. There'll be 2 listed companies, and, you know, I mean, to achieve net debt free is a big thing for us.
With respect to the FMCG business, the sale to GCPL, I just wanted to understand on the Park Avenue brand bit, right? So you also have Park Avenue in the branded textile space, and the FMCG bit you're selling. Just I'm trying to understand now, two different companies will own the same brand. How does that work? Do you think rather instead of selling the brand, a licensing agreement could have worked better?
Well, like I said earlier, the licensing is the same thing. It's just the structuring, whether you sell it or license it. If you license it for 20 years, you'd have the same outcome as you'd have from a sale.
Right.
It's just it'll be a different fee structure, different one-time amortization structure. So, frankly, I think Godrej is good in the space of the FMCG. Assuming we sell X number of cans of deos today, Godrej doubles it, triples it, quadruples it, there'll be a rub-off effect on the Park Avenue brand. And as the Park Avenue apparel brand grows, it'll have a rub-off effect on the FMCG brand.
Right.
Both companies will spend on advertising and marketing, which will help both companies.
On that note, we'll slip into a very short break. On the other side, we'll get chatting with Ramdev Agarwal, co-founder of Motilal Oswal Financial Services. Stay tuned for that discussion.